Founding, investing in, or working for a startup can be extremely exciting, especially if you find yourself attached to a rocket ship company that's growing in value over time. And one of the reasons that's so cool is because you likely have some sort of ownership in the company, whether that's preferred shares, advisor shares, employee stock options, or what have you. But when you go to sell your shares, there's one thing that catches a lot of people off guard, and that's taxes. In many cases, you as a founder, angel investor, employee, etc., might be making great profits on paper, but you don't consider that when you go to liquidate or sell your shares, a painful portion of those profits are going to get swiped away by Uncle Sam. Luckily, though, there's good news. Tucked away in a little corner of the U.S. Internal Revenue Code is a tiny little rule, a tax exclusion, which, if you qualify for it, could provide you with a pretty monstrous tax break when you sell your shares of that startup, possibly even a 100% break on your federal taxes. And the crazy thing is, a lot of angel investors, founders, advisors, and employees miss out on this tax exemption because they've never even heard of it before. The rule is called QSBS, and in this episode of Startup Essentials, we're going to talk all about it, what it is, how you can qualify for it, and more. But before we get started, if you find this kind of startup education content useful and you want to see more of it, do feel free to seek a tax exemption on the like button. Hit subscribe, tap the little bell for notifications. It's helpful for us here at Carta to understand what kind of content's useful to you so that we can continue making more of it. And with that out of the way, let's get this going. This is how to minimize your taxes when selling your startup shares, aka what the heck is QSBS? So, right up top, quick disclaimer, in this video, we're going to give a general summary of QSBS, but as always, we strongly recommend talking to a professional tax advisor before making any decisions about exercising or selling your equity. And shameless plug, if you do already use Carta for your company's cap table, we have a whole team of professional tax advisors available for you and your company who can help guide you through some of these complex decisions on equity. We know it can get really confusing. So if you want to learn more about Carta's equity tax advisors, we got a link right downstairs in the description. And now, let's get right into it. Right away, big question, what does QSBS mean? Well, it stands for Qualified Small Business Stock. And if you think about it, it means kind of exactly what it sounds like. If a company officially qualifies as a small business, then that company's shareholders could potentially get some tax benefits on their stock in that company. Qualified small business stock. So, okay, what kind of benefits? Well, generally speaking, when you sell your shares of a company, you're going to get taxed on whatever profits you make, right? These taxes are called capital gains, and they can be really rough, sometimes as high as 37%, depending on when you actually sell. But with the QSBS tax exclusion, if your shares qualify for it, you could potentially lock in a 0% capital gains tax rates for federal purposes. 0%. Think about that. If you sold a bunch of shares tomorrow and made $1 million in profit, 37% of that would mean you're giving up $370,000 to taxes. But if you can reduce that tax liability down to zero, I don't know about you, but I would take that deal in a heartbeat. However, here's the thing. Getting access to this tax exclusion depends on a whole bunch of complicated stuff, starting with, remember, the company you own shares in has to actually qualify as a small business when they give you the shares. So this leads us into two main questions, which are, number one, what does it take for a company to qualify as a small business? And two, okay, if my company does qualify, then how do I personally take advantage of this tax exclusion and save a bunch of money when I sell my shares? So we'll start with the first thing. What does it take for a company to qualify? A company is known as a qualified small business when it meets all three of the following requirements. Number one, the company has to be an active business that's incorporated as a U.S. C corporation. That one's easy. Number two is all about how many assets the company has. The magic number is $50 million in assets. And as you can probably guess, if a company wants to be a qualified small business, then it's got to be at or below that magic number at all times, leading up to and immediately after the moment the company gives shares to someone like you. So in other words, the company has to have a small enough amount of assets when it issues out the shares in order for those shares to be eligible for the QSBS tax exclusion. Okay, and then there's number three. There are some business types that are going to be unqualified for this benefit. The list is obviously a little dense, but the big thing to know is to be QSBS eligible, at least 80% of the company's assets have to be used in a qualified trader business, not one of these unqualified ones. So just to recap, one, incorporated as a U.S. C Corp. 2, 50 million or less in assets when the shares get issued. And 3, the company's got to be in a qualified trade or business. And if the company meets all of those requirements when it gives you shares, then congratulations, your shares just might qualify for the QSBS tax exemption. But there are also things that can cause a company to be disqualified, which is naturally going to impact those shareholders, a la you, who are trying to get the tax exclusion and save a bunch of money when they sell. In essence, there are 4 main ways that a company can be disqualified from QSBS. First, share repurchases. Sometimes a company might run like a buyback of its shares where it repurchases shares from the current shareholders. And without going into too many details on that, there's essentially a line or like a threshold where if the buyback exceeds that threshold, then all the shares that were issued within the year before that buyback could automatically be disqualified retroactively. And even worse, that buyback might also trigger a blackout period for the following year too. So whatever shares are issued in the previous year and the next year from the moment of that buyback wouldn't be eligible. Second, a lot of the time, a company might take its assets and invest them into non-cash deposit instruments, stuff like money market funds or corporate bonds, etc. But depending on the specifics of that investment, stuff like the investment amount, the company's age, or if the instrument itself has liquidity terms more than 24 months out, all of these kinds of little details about the investment could potentially impact eligibility for the QSBS tax exemption as well. Okay, that one was a mouthful, but luckily number 3 is pretty easy. If your company was a qualified small business, but then changed its business model and started to perform activities that are non-qualifying, then naturally your QSBS status might be affected by that. And finally, like we talked about under QSBS rules, your company's got to have less than 50 million in gross assets, both at the time when you issue the shares and immediately after. But here's the thing. Stuff like acquisitions, funding rounds, licensing agreements, and even changes to your company's inventory can cause the company to accidentally jump over this threshold and lose its QSBS eligibility. This is why typically companies tend to lose their eligibility after they've raised a few funding rounds. Okay, so we understand how QSBS qualification works on the company level, but what about you, the individual shareholder? At the end of the day, you want your personal shares to qualify for the tax benefits so you can save a bunch of money when you sell them, right? So how do you make sure that happens? In all, there are 2 things to know. There's an ownership component and there's a timing component. So just to make it easy, let's start with that first category, the ownership component. Basically, the thing to know here is you have to actually own your shares. I know that kind of sounds like a no-brainer, but you'd be surprised how many people actually get it wrong. If you're an employee, what this means is just because the company has granted you equity, like options, RSUs, etc., that doesn't mean that you actually own any shares yet. You still have to exercise the shares, aka purchase them, so that you can actually own them. And if you're an investor, same deal. You don't actually own any shares until the company converts your investment into stock, right? So that's thing number 1, real simple. Your shares aren't eligible for the tax exclusion until the moment you actually own them. Now, once you do own your stock, great, but what do you actually do about it? Well, right away, we recommend going straight to your company and asking one big important question. Now that I own my stock, is our company a qualified small business? If the answer is yes, then congratulations, you just might be on the road to a sweet, sweet tax break in the future. Which brings us to number 2. So we talked about the first component. Now let's go to the timing component. You own your shares and you know they're QSBS eligible. Now you got to hold on to those shares for a certain period of time before you sell them. Specifically, you have to hold on to your shares for at least 5 years before you sell them. And if you sell your shares before the 5-year mark, I am terribly sorry, but you will not qualify for the QSBS tax exclusion. But when that 5-year holding period is over, well, now you may officially sell your QSBS qualified stock and potentially exclude up to a whopping 100% of capital gains from your federal taxes. Congratulations. Now, like I said before, we're doing a general overview of how QSBS works here, but it actually gets a lot more complicated when you drill down into the nitty-gritty stuff. For example, right now we're talking about federal taxes, right? But what about state taxes? It's really just like a whole messy thing, and it can be really hard to follow all of these complex rules. And if you're a founder, it gets even harder because more and more these days, early stage investors are now starting to include QSBS eligibility in their fundraising documents, requiring that your company stay eligible for a period of time or under certain conditions, which if you think about it makes sense because if your company stays eligible, it could potentially protect a huge portion of their investment from being subject to federal long-term capital gains. Now, obviously the problem is staying QSBS eligible can be confusing. Among the 40,000 startups that we work with every day at Carta, we've seen countless companies lose their eligibility by accident because they didn't know the rules around stuff like share repurchases, vesting timing, managing their working capital, etc. So, if you do want to protect yourself and make it easier to stay QSBS eligible here at Carta, you can work with our advisory team to get official annual eligibility reviews, including one-on-one advisory sessions, year-round compliance support, and even official attestation letters proving your QSBS eligibility for tax filing purposes, audit purposes, and all that jazz. So if that's useful to you and you want to learn more, we'll include a link right downstairs in the description. And that's it, QSBS in a nutshell. If you found this video useful and you want to keep seeing more startup education content like it, we do encourage you to like, subscribe, hit the little bell for notifications, and we'll see you next time on Startup Essentials by Carta.